Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. It is not intended, nor should it be considered an invitation or inducement to buy or sell any of the underlying instruments cited, including but not limited to crypto assets, financial instruments, or any instruments that reference any index provided by CF Benchmarks Limited. This recording is not intended to persuade or incite you to buy or sell a security or securities noted within. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making any investment decision. Some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.
Gabe, are you going to buy Dog Whiff or something? You know, it's in an article, it was in a Bloomberg online article. It's the latest dog meme coin. It's a bit of a joke, it's a bit of a, slight another bonkers crypto episode. But what does this, on a more serious note, are we getting to the stage where, crazy things are happening? Are we actually seeing some overheating already?
Well, I don't think it'd be the first time that this market's been in this position where you start seeing these, meme or even like joke coins start to permeate through and garner a lot of attention. And surely it's probably indicative of the overall, optimism that you're seeing in digital assets again, which is kind of an overarching theme of our quarterly attribution reports that we're going to be talking about here in this episode.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. I'm Ken and Gabe, Head of Content, and I'm joined by Gabe Selby, our Lead Research Analyst. Hi there, Gabe.
Hey, Ken. As always, great to be with you. A lot of exciting stuff to dive into for this episode. We've had some pretty positive stuff happening in the crypto market, so happy to jump right in.
Absolutely. Pretty amazing times going on right now. And so this is a timely time to actually do our Quarterly Attribution Report edition, December 2023. What are the Quarterly Attribution Reports? Well, obviously they're every 3 months or so. Attribution relates to the fact that we release these QARs that enable our clients and any other interested readers to delineate market performance, crypto market performance, utilizing a set of tools that we have at our disposal. These are our major portfolio indices, as well as our unique digital asset taxonomy, the CF digital asset classification structure, essentially a schema for enabling investors and other market participants to get really accurate, precise ideas about what is driving the markets from one quarter to the next. So in this episode, we're going to have a quick market recap. We're going to look at how the market has performed, any major standouts on the upside and the downside. And then we're going to dive into some major takeaways that can sustain us in the weeks ahead as we enter into the next quarter. So Gabe, let's get things underway. What are the major big sort of like takeaways or banner things that you might want to point out at the top of this discussion?
Yeah, thanks, Ken. Well, these are kind of the exciting times that, we often see in crypto markets whenever we start to get more of a bullish price action permeating through from the top to the bottom. So it's been a pretty interesting quarter to dive into, to analyze. And I think given this enthusiasm surrounding possible spot Bitcoin ETF here in the US for early next year, we've seen a lot of institutional interest kind of grow substantially over the recent months. So I like to look at, the open interest on the Chicago Mercantile Exchange. That's where you'll find the Bitcoin and Ether futures traded. If you look at that metric, that's grown approximately like 76% for Bitcoin and 40% for Ether. So both of those are really on the uptrend, and Bitcoin actually made a new all-time high in open interest this last quarter. So, there's been a lot of enthusiasm there. It seems to be that the spot products that are in the pipeline for the SEC to approve has had a pretty significant impact here. And I think, rightfully so. ETFs are just the wrapper of choice of the 21st century, it seems like so far, they've really kind of taken such a significant share from the old mutual fund structure because of their low cost and tax advantages. So they've exploded in popularity since over the past few decades. Now it seems like I think the total in assets here in the U.S. in ETFs has exceeded $7 trillion this year. So it's pretty sizable money. It's because, mainstream investors, retail investors really like the ETF structure to gain these exposures across different various asset classes. And as we know, for crypto in the U.S., we have not had an approved exchange traded product that just holds spot Bitcoin. So I think this could be a significant turning point for the industry and its institutional adoption. And also, just given the names of the firms that are all applying, it kind of gives a bit of a stamp of approval, right? So
yeah,
for the asset class in itself. So I think all this recent data is just pointing to investor optimism, and that's why we're seeing such kind of bullish or positive price action across the board.
Yeah, I mean, there is all of that, and it's absolutely correct. So there's no doubt that is a major driver of the impetus we've seen over the last, I want to say, several months now. But it's almost like there's a little bit of a dilemma here because we're also, there's a bigger world out there apart from crypto, and we're talking macro-wise. To a large extent, there is this idea that this emerging idea of a soft landing that is actually, arguably becoming manifest, is also playing a part. And looking at one of our broadest measures of the crypto market, the CF Broadcap Index, 43% gain between the two rebalancing periods, subject to the current report, as well as a gain for the, obviously for the OG, the sort of main crypto asset, Bitcoin itself, 29%, more than respectable gain. How much of these sort of these sorts of uplifts can you attribute to the macro sort of picture, and how much could you or should you attribute to internal market optimism about these ETFs as you've sort of just explained?
Well, the macro picture certainly doesn't hurt, and there we've seen a lot of progress. And like what you were saying with the soft landing, the question is, is the soft landing still intact? Is it becoming more or less probable that we get a soft landing, or are we heading towards maybe even a no landing type scenario where inflation kind of just stays steadily high and we don't really have a recession or any sort of, cyclical end or cyclical beginning? We just kind of keep the status quo. That's going to be, remains to kind of be seen. But what we do know is that, inflation just kind of continues to precipitate lower and lower. This has had a pretty significant impact on interest rate expectations for the future, which is something that I feel like is super important to watch. And, most recently, and this is kind of outside of our attribution window of September 2nd to December 1st, but we had a FOMC meeting, a Federal Reserve meeting, where they updated their dot plots for the future. And several members there were indicating that their willingness to start cutting rates in 2024. So the market's starting to price that in. Some things to kind of keep in mind when you're looking for the soft landing to hold is, how is the risky assets performing? Equities seem to be pretty resilient. Digital assets are doing pretty well. Those have historically led other risky assets. If you look on the credit side, spreads for speculative grade, high yield, or maybe other asset-backed securities, those indices have had, pretty tight credit spreads. Nothing really showing up on the credit side to show any material weakening in the macro environment. So how much did that actually help digital assets? Well, we're going to talk about that a little bit later in the episode, where we've seen digital assets kind of show this divergent strength, or that's, a term that Mike McGlone, our former podcast guest, like to use. So I really like using that.
Soon to be our next podcast guest, or, a future podcast guest again, of course. No doubt.
Hopefully. But shout out to him. He's done a lot of work talking about this, and he's obviously been wanting to see this type of performance. So we can talk about that a little bit more later. But one thing that I just want to bring up front here is that, if you look at the performance of our indices, it's been pretty broad. So you said our floating broad cap index, which is kind of the most institutional broadest measure of digital assets that's institutionally investable performed pretty well. It rose about 43% over the last QAR period. So that's a significant spread over equities or other kind of peer group risky asset classes. So you've definitely seen kind of like a broader shift. Before we were seeing Bitcoin, maybe Ether, these two kind of mega cap tokens dominating a lot of the positive performance, but now it's starting to permeate through to the smaller cap tables. So that's important to see. It's very constructive, in my opinion. It's typically what you kind of get when you come out of troughs in traditional markets like in equities. You start to see maybe some large cap quality lead, and then the more speculative, smaller cap, less fundamentally sound companies start to follow. So bringing up the tide for all boats, that's kind of what we've been seeing in this past quarter.
Yeah. So just real quick on that specific point, Gabe. The idea is that as the positive sentiment or positive performance kind of fans out into the both sides of the tail, if you like, of the market, including the sort of lower capitalized assets, that is an indication of increasing confidence broadly for the crypto market. That's essentially what you're saying, right?
Yeah, exactly. So perhaps maybe we can jump into some themes here that we're seeing in the nitty gritty of our indices. So I'll give a quick kind of high-level overview of how the indices performed overall. Yeah. So which ones were the leaders, right? We already gave the listeners a tip on, what the overall market did as measured by a free floating broad cap index. That was around 43%. So the CF Web3 smart contract platforms index was the standout here in the quarter. It rose 73%. Second place, we saw the CF blockchain infrastructure index. It rose 64%. Both of these were, I would say, significantly outperforming the broader market. However, we did see more weakness, unfortunately, in the digital culture space. So our CF digital culture composite index rose just 28%. I mean, that's a pretty good return, right? So, but I think the context here is it's kind of key, because if you look at who was the major laggard in the peer group last quarter, it was also the digital culture index. So, if you were exposed to that segment of the digital asset universe, you've seen for the second straight quarter kind of a relative disappointing showing, despite 28% being a pretty sizable return over a 3 months period. So yeah, that's kind of how we've kind of observed these indices in the past quarter. And I think the important thing here is that we're starting to see more of an uptick in the altcoins and in these other smaller cap names. So those ships are starting to rise as well.
Can you zero in on any specific protocol, or maybe any specific set of protocols within the culture, or any specific movement where one can attribute or hang all the bulk of the underperformance, or the drag, I should say, really, for this segment? Because you say it did rise, but it just basically underperformed. Clearly, we're probably looking at something specific within that segment, or within that index specifically, or portfolio index, that actually is causing the sort of backwards pull, as opposed to the sort of forward momentum we're seeing for the overall market. Is there anything specific you can point to there?
There wasn't anything specific that was pulling the headline index in digital culture lower. Most of those tokens in the category were just not providing stellar price returns over the quarter. In fact, the majority of the the performance of that index was being attributed towards tokens that support digital culture. So you're
okay.
So it wasn't even in the headline index. The only token that had kind of a positive impact that was in the culture segment was Decentraland's Mana. That's of course a play to earn type protocol, and Mana is kind of the utility token that you use to purchase and play stuff in that ecosystem, and that's where that one token kind of outshined the rest of its category peers in the last stretch. And what I like to show in the attribution report is we did a chart showing the whale activity. When FTX collapsed last November, a lot of whales started selling mana in the market. So what we've seen is, kind of a flush out of that and a slow accumulation to the upside for whale activity. Now, what is a whale for listeners? We typically define it as any wallet that holds over 1% or at least 1% of the total circulating supply. So as we've seen kind of this accumulation of bigger investors in the mana token supply ecosystem, we've seen mana's price kind of recovery, and we've seen even more accumulation in the past quarter, according to this chart. So we think that, this kind of steady buying pressure hopefully signals, maybe a trough for that protocol.
Sure.
And that was really the one standout that we saw in that segment. So that's important to kind of point out.
Sure, and I don't want to labor, get stuck on one segment too much, or one index, one portfolio index. But I think there's a narrative circulating, and it's just an easy one to latch onto, and that's how narratives generally tend to circulate. That clearly the NFT space, if you like, in terms of like readily identifiable contributions to the culture aspect of blockchain economy, is still really suffering quite a bit. Pretty much every week we get a sort of an update that shows that NFTs are so 2022 or whatever it was, right? How much of a drag is that actually, if any, sort of perpetrating through the digital culture index and obviously showing up in terms of performance drag?
Yeah, no, I think that's certainly part of it. So if the broader ecosystem of NFTs and the stuff that you were just talking about isn't really recovering, then it would be kind of interesting to see, digital culture, performing better. So everything's kind of corroborating the fundamentals that you're seeing with the NFT market being kind of more in the doldrums. And this kind of runs counter to what you're seeing in the DeFi space, or decentralized finance, which is something that we like to highlight in the Quarterly Attribution Report. That's a segment that's seen, I would say, a sizable recovery over the last quarter. So, of course, decentralized finance, for listeners that aren't familiar with it, is a form of trying to recreate these traditional financial services using cryptocurrency technologies, blockchains, decentralized applications. And, after FTX, this area of the market really struggled. So one thing that we like to look at is the total value locked in DeFi protocols. And we've seen that kind of, get flushed out. It bottomed, and now it's recently hit a 13-month high. And I think, a lot of this recovery has been seen in these two kind of staple blockchains. So the Ethereum blockchain, the Solana blockchain, which are two key blockchains for facilitating DeFi transactions and providing these products. So we highlighted how much that's kind of recovered over the past 3 months. I like to look at Z-scores. So over the past 3 months, we've clocked in, 2 standard deviation moves to the upside on total value locked. And as we also highlighted, is that, Solana in itself, which was our leading performer in the broader universe, had significant, recovery in TVL as well. So that's kind of all corroborating itself as being, kind of a upward momentum leap in the DeFi space.
Yeah, let's you mentioned Solana. Let's just take that opportunity to drill down a little bit on Solana. In the Quarterly Attribution Report, an amazingly engaging report all the way through, there's actually a page on Solana with the headline, "Solana leads cryptos in year-end Santa rally." And second paragraph on that page is Solana led the pack, rising over 208%. That's for the quarter. That's amazing, right? So what's going on there?
So certainly it was closely affiliated with FTX Alameda. They seem to be really involved with the foundation. And so when that collapse happened, a lot of selling pressure happened in the market for Solana. We've since seen kind of a reversal of that, and a lot of enthusiasm's coming back into that protocol. It did lead the pack. We like to look at the broader market through our broad cap series, and just like, Solana, you had other tokens that posted these triple digit quarterly gains. So you had Render, RNDR, Chainlink, LINK, you have Immutable X, IMX, and you had Avalanche's AVAX. But yeah, Solana was leading the pack. If we look at the narrative side, before we jump into the fundamental side, a lot of it's been centered on the ETF frenzy because a significant thing that happened in the past 3 months is that we had BlackRock, one of our clients who uses our reference rates, file for a spot Ether ETF to follow up their spot Bitcoin ETF application. So that's now been put in the queue. And I think a lot of the investor community is starting to speculate, okay, well, if Ether's going to get thrown in there, maybe one day Solana will be too as well. So that's more of like a narrative push on the price action. But fundamentally speaking, you're also seeing this develop on-chain. So just like we were talking about the total value lock metrics of, the DeFi space, if you compare Solana's TVL versus Ethereum's TVL, and you compare their performance for the past quarter, it's almost proportionately ran in sync. So Solana saw, close to like 150% increase in total value locked, which, really kind of outperformed Ethereum, both on the price and on the fundamental side. So we can put a chart up there for the folks that are watching,
It's going to be like this for the quarter.
Be sure to check out the report, but that's kind of what we're seeing, in the Solana narratives.
Perfect. And just on that, a bit of a bookend for that topic. Obviously, we're in a sort of exciting time, and there's lots of speculation in the market, not just on price. There's also speculation about what's going to happen in terms of investment products, and of course the impact that can have on price. And Solana is a part of that. But a cautionary aspect, if you like, is that this is not set in stone, but you will not necessarily, the likelihood of you seeing an ETF application being filed even is much lower for an asset class that does not have a regulated futures market trading. So of course, we know that those spot Bitcoin and spot Ether ETF applications are, coming about after many years of trading on the CME Ether futures, and of course the CME Bitcoin futures. Although we do have a Solana price, I believe, Gabe, CME CF Solana reference rate, and of course a real-time index, the CME marketplace has not yet launched a futures contract or an options contract based on that reference rate. So we're getting ahead of ourselves, or maybe the market is getting ahead of itself in sort of thinking that Solana is the imminent next big thing in terms of the ETF application. ETF application and the sort of effects that we'll have. Do you agree with that?
Yeah, I would agree with that. And I think it's just important to kind of, bring that back up about the futures markets. And so you've seen a battle-tested, derivatives, regulated futures, standardized futures market over the past, 5. I think they launched when 2018 or 2017.
Late, I think it was December 2017. So pretty much
2017. We're coming up to 6 years of and for Bitcoin. Solana doesn't have that yet, and that's a major pool of liquidity. We talked about the liquidity complex that these derivatives, these regulated futures, the options kind of provide, with market makers being able to execute on these things to hedge their books
on our reference rates at the center of that complex.
So that's remains to be seen. But markets are always going to be forward looking. I think that's the reason why, amongst other confluence of factors, you're seeing Solana kind of lead the charge here. So I think a lot of it could be attributed to just a really healthy rebound from the FTX sell-off, along with the recovery in the fundamental activity on the chain, and as well as these bullish narratives that you're getting through just the media, through markets trying to price in any potential of a future spot ETF for something like Solana. Again, all those things that you just said are 100% right, and so we could be a ways away. Certainly, let's just try and see if we can get the Bitcoin one approved, and then let's try for Ether. Anything past Ether, you still are running into a lot more regulatory headwinds. So we're just kind of going to have to wait and see on that one. I would agree.
Yeah. But nevertheless, a healthy and, apparently justified rebound, maybe a surprising escape as well to an extent. Gabe, I wanted to talk about altcoins before we move on to the next section. I think one of the observations that you sort of had, overarching observations within this report is that altcoins, did particularly well. And I'm kind of interested in the altcoin sort of piece, mostly because generally, at least for the last year, altcoins have served as sort of a function as a bit of a canary in the coal mine. I think you're probably familiar with that phrase. And so when altcoins rally, it's not necessarily always good news, in other words. It's sort of like, presages either the beginning of a particularly frothy period, or it's sort of like presages the sort of top of a positive period. That's the sort of observation that I've had over the last year or so. But I think that your idea about the altcoin rally in this quarter is that it's something different. Can you give us a bit of a takeaway on that, maybe?
Yeah, I think in this context, we're seeing more of a spillover from those two mega cap tokens that are grabbing a lot of the mainstream institutional focus into the other protocols. And overall, that should be viewed more constructively than perhaps signaling, some sort of irrational over exuberance in digital assets. I think altcoins largely were kind of left behind earlier in the year. We've seen Bitcoin dominance continue to trend higher. That's good gauge to just kind of get you a feel of, kind of the overall sentiment in the market. Sometimes when Bitcoin dominance rises, it's typically because of a risk-off period, and you see that the altcoins get sold off, at a greater scale relative to more established, larger cap Bitcoin. So we're still seeing that kind of dynamic with Bitcoin dominance trending upwards. But I think, it's definitely more constructive to see these smaller cap altcoins starting to participate in the rally as we come towards year end, as we start to get, into this, what if we get, a spot product approved here in the US, which is, again, the largest capital market in the world. So it's pretty significant. And for the first time to have these types of products available for customers, to give them the option to own cryptocurrencies in other mediums of exchange outside of, traditional digital wallets, either cold or hot. So again, we're in this period where it could be pretty pivotal in the future for the institutional adoption trend here in early 2024. And it's just, I think, a healthy rally for smaller cap altcoins.
Yeah. And, let's dig a little bit deeper into that broader market, some broader market takeaways, Gabe. Another thing that stands out from reading your Quarterly Attribution Report is apparently some declining volatility. It looks to be across the board. Now, of course, when we hear the phrase declining volatility, we think back to the summer. Those summer doldrums were maybe priced as well as volatility. They may have been related to, activity in the market that it was seasonal, but a lot of those volatility measures are actually at all-time lows. So if you're saying now that we're seeing declining volatility, from what sort of from what basis are you actually saying that? Was there an uplift and now there's a sort of further decline, or another sort of a retrograde step, or what are we actually saying here?
Yeah, it's an interesting thing to kind of highlight, and a lot of folks have been kind of pointing to it because critics of cryptocurrencies often point to the extreme volatility as a red flag for the asset class, and that's understandably so. So what we can do is we can take our floating broad cap index, which again kind of gives you the best institutional grade investable universe of the digital asset space, and we can study the 360-day volatility of it. And, let's just look at it and let's compare it to something like stocks. In this case, in the attribution report, we compared it to the NASDAQ 100 index, which is a very tech-centric kind of high-flying index. And despite, some higher historical swings relative to stocks, the CF Broadcap Index, again, just hit a multi-year low for its 360-day volatility. So it's one thing to look at the volatility of the market and do a judgment call on that. But what we also want to do is see if we're getting compensated for the additional risk. And what we also did was just kind of look at the Sharpe ratio, which is a common measure of risk-adjusted returns. And we do that. The data does say yes. Our floating broad cap index has kind of consistently offered better risk-adjusted performance than the NASDAQ 100 index, which, over that period was, I would say, one of the top performing equity market indexes out there. So what you have to do as an investor is maybe not so much fully discriminate against risky assets because of their volatility, but take a more nuanced approach. Try to risk adjust those returns, see if you're getting compensated for it, and then size your position in your portfolio accordingly. So we've always used this 1 to 2, 3% rule for allocating the digital assets if you're new to the space. This is a percentage that, historically speaking, has not significantly changed the risk profile of a diversified, global portfolio that's invested in multi-assets. So this is something that, we're just trying to highlight again so people can understand. Yes, cryptocurrencies have had historically high volatility. It's continuing to decline as the asset class continues to mature. But also, if you've been a strategic investor in the space, you've been fairly compensated for that additional volatility.
And we've got onto market statistics, Gabe. So we might as well at this point talk about correlations. You might want to mention intra-market as well as a cross-asset sort of picture. I think clearly the cross-asset picture is of real interest to a lot of people, because the last time we did one of these attribution report editions of the podcast, one of your main observations, I believe, was that the cross-asset correlation between crypto and perhaps with Bitcoin in particular and the broader equity asset class was actually beginning to show signs of decorrelating again. So can you kind of bring us up to date on the correlation picture?
Yeah, absolutely. I mean, it's a very important part of portfolio construction is to kind of understand all the pieces that you have to work with. And so looking for assets that can provide lower correlations, mainly to risky assets such as stocks, is pretty advantageous for investors. And during the recent bull and bear runs, we've seen crypto prices kind of trade in lockstep to U.S. equities like the S&P 500 or the NASDAQ 100 indices. However, we are starting to see some decoupling, and a lot of it has to do with these fundamental and bullish constructive narratives that you're getting in the space right now. So again, divergence is going to bode well for investors if we continue to see this decoupling effect, because it gives you the diversification benefits, which is, as Harry Markowitz would like to say, it's the only free lunch is diversification. So reduce synchronization across the space with these assets is very key. I think the factors enabling this is kind of this continued maturing dynamic that you're getting in digital assets. As we come closer to maybe getting a spot Bitcoin ETF approval, you're kind of getting, more institutional interest in there, more institutional players in there. It's going to trade, I think, a little, it's going to go back to maybe its long-term historical correlation levels, which is much lower than what we saw in 2021 in the bull run and in 2022 during the bear run. So I think a lot of those factors that kept crypto in lockstep with traditional risky assets was largely due to the overall macro environment. In 2021 or in 2020, you could say after COVID through 2021, you've had a lot of liquidity being pumped into the financial system. You have rates very low, right? So it was kind of creating this indiscriminate bull market rally, which was a pretty strong tailwind for everything in the risky asset spectrum. And then at the end of 2021, when the Fed, I think it was in the November meeting, declared that inflation was no longer going to be transitory, and shortly after they started increasing interest rates, you kind of had a complete inverse of this dynamic of massive liquidity, easy financial conditions. So you had a kind of a complete reversal of that, which pulled a lot of the punch bowl out of the party. And that's why you saw a kind of a non-discriminatory bear market. So you had equities selling off, you had digital assets selling off, and that's kept these correlations tight. As we came into the last year, we've seen more of these idiosyncratic stories take fold. along with the possible approval of these spot ETFs. So that's, I think, the major factor here that's contributing to the kind of this decoupling, and it's kind of giving us back into a space where we will see maybe digital assets kind of trade in a relationship that's closer to the long-term average, which is a very low, like a 0.2 to 0 range on the correlation to traditional risky assets like equities.
Yeah, that brings us back to Bitcoin. I mean, as you've mentioned, Gabe, Bitcoin was not this during the most recent Quarterly Attribution Report period, the shining standout there was in prior reports, for good reasons, because as you said, all boats were lifted by the current dynamics of both macroeconomic and also intra-market related to the spot Bitcoin ETF, pure optimism, right? But Bitcoin still did actually perform very, very well. So there's an element that in line with that decoupling from broader markets, including particularly equities, Bitcoin is still sort of like showing some sort of like divergent strength that maybe we can sort of like have an eye to continuing for the medium term or for the future. Certainly one to watch, right?
Yeah, and what we did here in this report is we took the S&P high beta equity U.S. equity index, and we also took a risk off asset class like the treasury market.
Right.
And we observed over the last 3 months, the high beta portion of the U.S. equity market underperformed the safest part of the fixed income market. Categorically speaking, you could say that this was kind of broadly a risk off type dynamic that you saw in the markets. So adding to that decoupling effect, we saw digital assets completely outperform both the traditional asset classes on the fixed income side and on the equity side. So in a period where you would say, okay, we saw risk off flavors through the price action, bonds outperforming high beta, you would expect if the correlations remain tight, that digital assets would have done even worse than the high beta segment of the market. However, that was not the case. And so it's something to check out in our report. It's an interesting thing to just kind of keep in mind that, compare these two things and see how the price action is. But right now, it's showing a lot of divergent strength.
Absolutely. And I love that sort of experimental, test of underlying market strength, talking about the traditional financial market, listed financial market relative to crypto, because it really is telling us a bit of a story. So Gabe, as we wrap things up, what would be the main takeaway that you would like to, imprint on readers and everyone else's minds?
We're entering this very pivotal moment for the industry. What we might see early in 2024 could be just, the first major steps in many for the space to kind of get more institutional traction and more adoption in the future. And so what this quarter was telling us was a bit of kind of like the cues or the tea leaves, right, of how this asset class might look like if we continue to go on this path of becoming more of a widely accepted asset class, because it's still an early asset class. It's still emerging. Bitcoin and its market cap, it's still under $1 trillion, and so it's much smaller, than the gold market, which is kind of what it gets compared to. If you look at Ether and the Ethereum blockchain, the decentralized app ecosystem is still in its early days. Developers are working hard to try and get that scaled up so you can have a lot more real world use cases. So one of the main takeaways that I would say is, we're coming to a very critical period here in the start of the new year. And I would say that's A. And B, it's still early days. So
yeah,
we're not like in the ninth inning, and we're just kind of getting started here.
Absolutely. Okay, Gabe, thank you very much indeed for that amazing overview of an amazing quarter. It's kind of like not a bad way to wrap up 2023 after a slightly less fortunate way that we wrapped up 2022, a little more a year later. We are looking at a much better prospect for the year ahead. For those of you who haven't read the attribution report yet, of course, you can find it at cfbenchmarks.com. find the Quarterly Attribution Reports tab and read it online or download it to a PDF. Of course, we do have our other content released regularly on tfbenchmarks.com, the market recap and the newsletters. And additionally, of course, if you're interested in further podcasts, you can find all the episodes on Spotify and Apple and other major platforms. With all that, thanks you very much for listening and viewing, and we'll see you again soon for another episode of CFB Talks Digital Assets.